Market watchers say volatility in the stock market will continue to be the theme in 2015 as many investors are bracing for an interest rate hike in the US and global turmoil. They say the rate increase may shake stock markets worldwide. But the US Federal Reserve said it will take a patient approach in deciding when to bump up borrowing costs higher. Elsewhere, in places such as Europe and Japan, the economies are not seeing massive growth. Hence, retail market strategist at CIMB Research, Benjamin Goh, says central banks in Japan and Europe may implement major quantitative easing to boost their economies, which can offset some negative impact from the rate hike in the US.
We've seen in the last 5 years or so, right, whenever economy is not doing so well, equity markets are sliding, central banks may implement stimulus packages. So Europe might be on the cusp of actually implementing their own stimulus package that may effectively expand money supply. So if that happens, then equity markets in Europe also will come back quite strongly. If market sentiment, investor confidence improves globally, then Singapore would also be riding the wave. So if everybody is happy, confident, markets going up, Singapore will definitely be moving up as well.
According to OCBC research, the valuations of Singapore shares are reasonable against historical averages. The STI is currently trading at a ratio of 14.4 times forward price to earnings for fiscal year 2015. GCP Global's executive chairman, Gabriel Yap, says valuations are fair, but Singapore stocks are simply not attractive.
The retailers to come back to the market, it is not so much about basically the value of the shares, but it's actually the attractiveness of the shares, where investors think that they can make money. That is where they will then be pouring money into the stock market. And this is where they actually have a big headache, because most stocks either actually suffer from lack of interest because of its small cap categorizations, or if they belong to the big cap, then there is always a considered effort to find good value stocks for which there are few and far in between.
Mr. Yap also says trading volume of Singapore stocks was dampened this year, with the two recent shutdown incidents at the Singapore Exchange adding to the muted market mood. Earlier this month, the SGX delayed the opening hours for 3.5 hours due to a software defect, and the exchange also halted trading for 3 hours last month due to a power outage. Falling oil prices also added to uncertainties in the markets. Among the doldrums, Mr. Yap says there are still some gems to be found. He cited banking counters and REITs to continue to be the bright spots next year.
The banks essentially are riding on higher loan growth, as well as the fact that the net profit margin, which have actually maintained or improved slightly. The next sector that have actually benefited is actually the REITs. The fourth sector are the business trusts. And last but not least, I think the healthcare sector has also done pretty well this year.
Another analyst, Roger Tan, CEO at Voyage Research, is rather upbeat about export-related stocks.
If the US continues to grow strong and hopefully somewhere along the line, Europe's economy comes out. So I think if I were to look forward to 2015 and pick a sector, I think anything that has fundamentally good export markets in the US and in Europe would be something that we want to look at. Go for bottom-up analysis, try not to go from top-down analysis.
Amid continued volatility in the stock markets, market experts advise investors to take a long-term approach, as volatility is not necessarily a bad thing. Instead, it creates opportunities.